you everyone for joining us. And without further ado, I will turn it over to Med Garada to talk to us today about ASC 842 leases and ASC 606, the new revenue recognition standards, as well as Leasecrunch, the software that we have implemented firm-wide to carry out these new standards. Thank you,
All
Garada.
right. Thank you, Maddie. Hello, everyone. Hope
Hi.
you're having a good Wednesday. All right, let's jump in because we have a lot of stuff to cover. All right, so I'll start first with revenue recognition, which is accounting standard codification 606. And just obviously before we jump in, these are obviously going to be the revenue recognition under accounting principles generally accepted in the United States. So if you're good, for example, that for tax purposes, or you're going, for example, on IFRS or cash basis, just let you know that revenue recognition standards would be different. So this is just applicable to GAAP. Sounds good? And if anybody has a question at any time, please feel free to stop me. So back in the day, we had accounting standard codification for the revenue recognition. It used to be called 605, and we had 606 being implemented actually for a few years now. If I remember correctly, the first implementation for public companies were for years ending after December 15, 2016. And for private was for, which is all the companies that we work with, privates and not-for-profits, is going to be, was December 5th, years ending after December 15, 2019. So we're going right now on our third year. So, all right. The revenue, there is five main categories, main criteria that are required for revenue to be recognized under ASC 606. And what I'm looking at right now is one of the it's going to call this ASC 606 revenue recognition practice, for which is from BDO. And I'm on page, if anybody wants to follow with me, I'm on page 3. I know I skipped page 2. It just covers what we mostly spoke about here regarding the public entities and non-public entities. And
Garada, these are saved where?
These are the ones that I shared with you in the email. I'm actually going to save them all in the location that you sent me as well.
Okay, I can do that, and I'll send the link in the chat, so in case anyone wants to follow along, you have these. I didn't send them out to everyone before, so thanks.
Oh, I can do that as we speak right now. It's not a big deal.
Okay, thank you.
And I apologize, I should have saved them. The location. Hopefully. Correct, I think comes through. To if I do all Miller Mosmar, would that work?
I think so.
All right. All right. So going back to here, so there's 5 criteria for revenue recognition. First is you need to have identified a contract. And second, you need to identify what is the performance obligation. Third one is determine the transaction price, and then allocate the transaction price to the performance obligation, and then you recognize the revenue. So I'm going to go one by one and explain what you need to look out for specifically. And I'm going to focus primarily on government contractors, since it compromise a large percentage of our clients. And I would generally say that if you have a client that's providing services, it's going to follow suit for the most part. So before we jump into that, there's normally there is two forms of revenue. There is something called revenue at a point of time and revenue over time. So I'm going to show you an example, for example, for the disclosures that we have. But the idea is that revenue recognized at a point of in time is means when once the performance obligation, which is the performance obligation is just the fancy way of saying that we met our obligations to recognize revenue. So if, for example, if it's times and materials, we actually did the work and we spent an hour, so now we can bill for an hour. The idea, generally speaking, so that we have two categories. There's the revenue recognized at a point of time and over time. So at the point of time is if you're providing a service, whether it's times and material or fixed firm price, is that you provided the service. And that's going to be, I would say, 95% of all the government contractors, whether it's times and materials, cost plus, or even or fixed firm price, it's all at a point in time. Now, if you have something that's a subscription based, that's going to be overtime. And just for example, to uh, I use DQ, which is also a government contractor. Oh, right away. So that's usually it's going to be how it's going to be divided. And again, the reason why DQ had performance obligations satisfied overtime is because they have subscription for software, while everything else remained as at a point in time. So going back to our presentation, which I moved by mistake. So first off, let's talk about the contract. So to identify there's a contract, and most government contractors that are gonna have a written contract, I'm sure everybody have seen one before. It's gonna say specifically how much you need to bill and all that. Um, just to let you know, a contract does not have to be in writing. At the government, I mean, it's not. It's always going to be in writing for the government, but I'm generally speaking, it may not be in writing. It has to be approved by obviously the buyer and the seller to be able to be a contract. However, it doesn't have to be in writing. It and again, going through here, contract has been approved, rights and there are specific rights and obligations that needs to be transferred. Oops. Contract has commercial substance and so on. I'm not going to get too much into multiple if the combining multiple contracts. It can happen. It's just not. It's not really going to something we're in. I mean, when we're doing none of our audit clients so far, we're into like combining multiple contracts at the same time. So I'll just move to the next one. All right. What is performance obligation? So the definition is performance obligation is a contractual promise by an entity to transfer to customer distinct good or services. So again, if we are, for example, going with a government contractor, we are going on a fixed firm price. Let's say it's a 1.2 million contract for every year. So it's going to be $100,000 every month. Once we do the work to recognize the $100,000 a month, we just bill for it and we can recognize it at the end of the month. Times and materials is pretty much the same concept. We worked, let's say, for example, on a contract, 500 hours in a month. We build the 500, once the month is ended, we build the 500 hours and we can recognize it. It's, if it's a subscription based, again, it's going to be on monthly basis. So let's say, for example, you have a 12-month contract. Every month you're going to divide it by 12, and every month you can recognize 1/12 of it. So going down to determine the transaction price.
Oh, Garada, I know you've got a lot to cover, so I'll keep this question short. But
Sure.
so okay, it seems like it's kind of clear for time and materials and cost plus fixed fee contracts because you're doing that work. And so pretty much it seems like it's okay to recognize revenue based on billings, right? So as those billings are done, because that's showing that the work is performed. Is that
Not, I wouldn't say yeah. The answer is yes. However, if you're doing 100% accrual correctly, you want to recognize it in the like. So, for example, if this is December's revenue, you might bill in January, but you still want to record the date as of
sure?
December, so it's reflected in December. I know some
Exactly.
accounting systems might have some like issues, like you have to post it an adjustment first and move it. We ran into this with when we were audit clients, I think with MetroStar in particular. I don't remember if DQ had that issue or not. So the question isn't necessarily if when we bill, it's when we actually perform the work. So if we
Sure.
perform the work, then we're entitled to recognize the revenue at that point. We met the performance obligation. So that at that point, we can recognize the revenue. We don't necessarily have to bill for it.
Perfect. And then on the firm fixed price side, so you gave the example of $1.2 million contract per year. So that would be $100,000 per month. But what if, for example, that $1.2 million contract was milestone or deliverable based and you build at specific points in time, like maybe twice the first year and then once? Do, would we need to be looking at percentage of completion type thing or just based on the milestones delivered? Can you speak
Yes.
a little bit about that? Yeah.
So I'm gonna go into that. I was gonna go into that in a little bit in the end, but let's since we brought it up. Um, so normally, if the performance obligation, if you have a milestone, then the performance obligation is met once you meet the milestone. So I would say I would say with the exception maybe of one or two contracts that I had with DQ, we never ran into this in any of our audit clients that were government contractors. Very rarely they would have like a specific milestone to meet for you to recognize the revenue. However, if there is, like let's say for example, if you're developing a software and you have to develop, for example, a portion of the software or like a specific technological point, then you can't really recognize the revenue until that point because you can't really, if you stopped working on it as of that point, you wouldn't be able to bill for anything because you didn't reach the milestone. So you have to reach the milestone first before you can get there. And I don't want to get too much into so percentage of completion, it's almost stayed the same like it was before, with one caveat. Again, it's you have to ensure that you're meeting the benefit obligation. So it's not so much like I don't see this at all almost in government contractors. It's more happening if there is, let's say, a software development or which we didn't run into so far during our audits. However, how it normally works, again, it's gonna be uh, based on performance obligation. So, for example, if you have a milestone in it, then you have to reach the milestone first before you can recognize that specific amount. If you didn't meet the milestone, you can't. If there is no milestones, then it's probably gonna follow a fixed firm price kind of deal where you're gonna divide it over the period of performance. So again, the main thing that I want to keep in mind when you're looking at contracts is you want to know if there is anything that's some like a milestone or something criteria that you have to meet in order for you to recognize the revenue. And once we finish this, we actually have a checklist that we that I shared that we used to use in the first implementation of accounting standard 606. So the idea is that most of the answers are to all of these are no for normal recognition. If the answer is yes to any of them, then you're going to have to figure out what is what is not no, what is there that is out of the ordinary that can prevent you from recognizing the revenue.
Thank you.
Let's. I know we don't have too much time, so I'm going to jump to the next one. Determination of transaction price. This is mostly easy. Again, if you have a written contract, it's usually going to be right there. And for services, it's almost always going to be some like a very specific price, excuse me, determined either by contract, like even like if you send an email, something of that nature. Now, in some situations, and I'm gonna just give one an example because this covers both if there is multiple things bundled together. Once we finish this, you might have to allocate the price if there is more than one thing bundled together and they're not recognized as revenue at the same point. So I'll show that once we get there. And again, which is allocate the transaction price to the performance obligation. And again, there could be this is the point is there could be multiple performance obligation. Again, I'm going to use the software as an example. If you're developing a software, if you're, let's say, selling a software and you're providing maintenance, these are two different services, technically. Even if you bundle them together, there is two performance obligations, not just one. So you might, when you sell for example, you sell the software, you can recognize the entire revenue at that specific point. However, the maintenance is going to cover a period of time. Could be a year or whatever the case may be. So you can't just recognize the entire revenue for both at the same time. And the example that I'm going to get into, which when we get there, is let's say, for example, you sold the contract as of December, and well, let's say November. Then you're providing maintenance over a year, so you can recognize the software at that point. However, the maintenance you can only recognize 1 month of it during that calendar year. And if you are billing, you're providing all this for one price, you're gonna have to allocate the price among both services. And I'm gonna show in the example how. And again, once performance obligation is satisfied, that means all the other stuff that we have a contract, we know what our performance obligation is, know what our price, and we figured out how to allocate it, that at that point we can recognize the revenue. And before we jump actually to the presentation, I want to show you the example that I was talking about. And so there was another PowerPoint that has a little bit more information regarding revenue recognition. And the example they're using here, it's kind of similar. They're selling a product versus a software. And the idea here is that the product on its own has a price of $240. And on top of that, they were providing a subscription, which is, I think it was warranty in this case. And the warranty is valued at $60. However, when they sell the product and the warranty together, they sell them for $250. And the idea is that since so 240 and 60 together is 300, that means 80% of the value is allocated towards the product and 20% towards the warranty. So when we sell it to 250 and we want to allocate the price, if it isn't listed specifically in the contract, like how much is allocated, you're gonna have to figure out like how much we allocate for the product, how much we allocate for the warranty, then using the actual price that we sold as a percentage, figure out what percentage of the price is going to be allocated towards the product and what towards the warranty. Makes sense? And again, I know I'm going on this a little bit too fast, but the idea is that you have something that's the product and the warranty together separately, they would come up to be $300. And again, it's 80-20. So when you actually sell them together for 250, you just allocate 80% towards the product and 20% towards the warranty when you recognize the revenue. All right. And going to the financial statement presentation. Again, there is a few things that we need to disclose, which is desegregation. This is all started with Accounting Standard Codification 606. It was not there before. You have to do a desegregation of revenue. What that means is basically what I showed over here is first you need to show what is being performed at over time and what being performed at a point of time. Then I don't think it's on this example, but let me use another example over here for a little bit more of a more complex client in terms of revenue. The idea is that every line item over here on the balance sheet, sorry, on the income statement, you need to show how the revenue was desegregated for it. What that means is, for example, let's say the client has offering multiple services in one line item. You have to come in the notes and be like, okay, for example, they provide the monitoring service, maintenance, warranty, whatever the case may be. You just have to come in the notes and split them. And again, for most government contractors, it's going to be something that's straightforward, which is going to be performance at most of actually government contractors is just going to be at a point of time, not even satisfied over time. So it's going to be pretty simple. Just keep in mind, if it's not, then it's going to look more complicated. And again, you have to really go quick, like talk in the notes as well about the performance obligation. How is it? What is the performance obligation? How is the performance obligation met? As we just covered for a government contractor, for example. So just stuff that goes in the notes right here. And if you have something fun like the PPP, then you have to like talk a little bit about it. If there's anything that's out of the ordinary as a revenue, it's like, hey, this happened just this year. It's not going to be recurring. And we recognize it because the government gave us money. Stuff of that nature. All right. Any questions on the revenue recognition? Going once, twice. All right. Everybody's now an expert. And again, just the thing is that you want to keep in mind when you're working, especially like in, I would say, our accounting and audit team, is if there is anything that looks out of the ordinary. And again, I forgot actually to open the list. So let me go back here. And so I shared with everyone this list right here with, if it ever opens. Oh, here it is. Yeah. The car is not included, by the way. So the idea is to hear like, do you have an agreement, all that stuff. The idea is that the answer for most of these are going, do you have any termination? Like obviously you need to have an agreement, but most of the other stuff is going to be no modifications. And if the answer is yes, normally for any of these, then you're probably going to have to dig further and to figure out if the performance obligation is met or not, or there is more than one service or product bundled together. And again, this is just like a fast checklist to give you an idea. And we use again this for the implementation for the first year. The idea is that just keep in mind if there is anything out of the ordinary when you're looking at the contracts, especially for government contractors. All right. Jumping to leases. Sorry, I apologize. All right. So it, the new lease standard, and this is going to be effective for fiscal years 2022. So it's December 5th, years ending after December 15, 2021. And this is going to be effective for all clients that have a calendar year of ending December 31st, 2022. So this is going to be our first implementation, which is going to be really fun. All right. So giving out the 50-foot view, what the new lease standard is doing is basically what it's going to add an asset on the financial statement and a liability for the entire lease based on its duration. So if let's say, for example, you're leasing office space, you're paying $100,000 in a year for 5 years. You're going to have an asset, roughly, not exactly, over $500,000 sitting on your balance sheet and a liability for, again, $500,000 sitting into your liabilities. The reason why they're doing this change is they wanted to capture the liability and the asset that you get from long-term leases. And what that's going to do, before obviously we didn't recognize, based on the current lease standard, we didn't have any assets, and liabilities was only deferred rent. Well, we had prepaid rent if we had prepaid rent, but the only liability was really deferred rent when it was applicable. But now we're going to have a large asset and a large liability that is sitting on our balance sheet. And again, the asset is going to be called the right of use asset. And again, lease liability is lease liability. As part of the right of use asset is going to be amortized over straight line based on however long the asset is. So if we have 66, it fits 5 years, it's going to be amortized over 60 months. The liability is kind of similar, but a little bit different. So just to give you a heads up, the liability is comprised of multiple things. It's not just 12 months of the asset and that's it. You're going to have to consider the time value of money. So there is an interest rate calculation involved. And again, we are going to be using Leasecrunch, which I'm going to go over right now, that calculates all that nice stuff for us. It's a little bit complicated. All right. And again, the key terms is just right. So again, the right of use asset, right to control the asset. It's kind of similar to before, like the idea is that you need to have control of the asset that you're renting. So when the control transfers, so let's say, for example, you have a lease that starts on December 1st, but for some reason you didn't have access to the space until January, for example, 15th. January 15th is when you start recognizing the lease and doing all your adjustments and all that. All right. And the lease liability, which is basically measured as the present value of unpaid lease payments. The discount rate. The discount rate is going to be about the incremental borrowing rate. So just to let you guys know, what the AICPA has been advising is for not auditors, for accountants and auditors to use the risk-free rate as our discount rate. And that was done a few months ago before the interest rates skyrocketed. We're still going with that. Most of the if you are having the lease starting January 1, 2022, or well, this is the first period of implementation for all these leases. I think it's about 2.05, the risk-free rate, which is that 20-year treasury. If you're doing it closer to the end of the year, it's like 4.5%. So it's a big difference. So steps of implementation, and I'm not going to go through all these. The one thing that I wanted to point out is that we are going for all our leases so all our clients obviously have leases that are stretching all over the period. So it's not just starting as of January 1, 2022 or after. Most of the clients are going to have leases that are going to be way back. And the idea here is that for all clients that have leases like this, especially if you're prepared for audit clients, is that you're gonna have to implement it as of January 1st, 2022. There are multiple ways to do it. One way is that you go back and rechange the entire lease based on the new lease standard, which is called It's called retrospective, and that's not what we're going to do. And if the client tells me they want to do that, I'll just tell them to do it on their own time. What we're going to do is something called modified retrospective, which what it does is that 2020, 2021, and before, the past is in the past. We're not going to get into that. Even if we're presenting a comparative financial statement, it's going to stay the same as last year. No changes. You don't have to change anything in the net assets, none of or retained earnings, none of that. If you have a lease, for example, that's starting, let's keep it simple, January 1st, 2020. So 2 years before the lease standard is applicable. You're not, so you're for the and let's say it's a 5-year lease. Your implementation date is going to be for the new lease is January 1st, 2022. And anything that's before that, that's gone. So right now, you're going to be treating the lease as if it's a 36-month lease, 3 years, versus it being 5. And you're going to calculate your the right of use asset, the liability, and all that starting January 1, 2022 for the next 3 years. What happened the 2 years before that are gone. And again, this goes over this. Yeah, we're not gonna restate. We're gonna do the modified retrospective approach, as I mentioned. The one thing I wanted to point out, and this is again as an example, because we are going to run into that a lot when we're dealing with a client, especially if the client has loan covenants. Is right now, for example, this is a like a client that we have, for example, that we added here. So this is before the new, this is the old under the old standard. This is the new standard. And what I want just to point out is there's uh, you see here there is a right of use asset, for example, for $600,000. So what's happening if you see right here, this is the only difference between both balance sheets. And if you see how much the asset grew right here, but the right of use asset is a non-current asset. It's not a current asset. However, the liability is going to have a current portion. So if you're looking at working capital, quick ratio, or current ratios, these are all going to go down because what's going to happen right now, before we didn't have a lease liability beside deferred rent on our in the liability section, which now we're going to have. It's going to be a current liability of whatever the case may be, and you don't have a current asset corresponding to it. So what's going to happen is just all your liquidity ratios are going to go down. It's one of these things that we might want to have if we're dealing with specifically with banks or loan covenants. We have to keep an eye for. I don't know if any banks are going to be changing the covenants or how exactly are they going to react. I'm pretty certain that a lot of our clients are going to run into that issue, specifically regarding not meeting the covenants. And I'm sure this is something we can work with the banks with. Just keep in mind, it's something that if you run into, if you have a client that has covenants, they're not going to meet the covenants. So you might have to talk to the client, to the bank, whatever the case may be. Just keep an eye for that. All right. So back in the good old days, well, as of right now, this is going to be the disclosure for the current revenue lease standard. Basically, it's like, hey, we have a lease. You actually don't have to list them. We just have leases going over which we're recognizing straight line. And here is the commitment for the next 5 years and thereafter. Easy. Not anymore. So there is tons of stuff that you need to be disclosing. You have to disclose the right of use asset, the liability, how's the liability calculated, and then you're going to have to present the leases in detail, how you're amortizing it, over what period, maturity, and all that stuff. Present value, the undiscounted cash flows. And again, this is one of these when Leasecrunch is going to give us the notes that we need versus us trying to know exactly how it's going to look like. And the notes are going to look, this is not exactly how the note is going to look like, but close enough. It's going to describe like it's just like in detail all the stuff that we covered. Which takes us to Leasecrunch. I believe everybody has access to Leasecrunch. If not, you should be, we should, I don't know who you can ask if you don't. I don't know if Angie's is on.
Cynthia and Angie. Intezar, you have a question?
Yes, before we move to Leasecrunch, why exactly there is this side of the current portion of the lease liability, right of use lease liability, but there is not the current portion in the asset? Like, why exactly that happened? Is it
It's
because,
the simple answer is this gap says so.
oh,
But
well, the way I'm thinking about it is that
yeah,
in the lease liability, right of use lease, they categorize things according to maturity. and whatever is mature within 12 months, it should be automatically in current. But an
I
asset,
agree. Yeah,
yeah, and assets, it should be convertible to cash within 12 months, which is not actually in the asset side. Maybe that's why, but I'm not sure.
you're right. And but unfortunately, this is what Gap wants us to do. And I think the logic behind it is that the asset is not considered liquid. Like the liability, you have to pay cash. You don't have a choice.
Yeah,
For example, if you have rental, you have to pay for it, but you can't really use the like something from the asset. The asset itself is not liquid. You can't liquidate it. I think that's the logic behind it.
exactly. Yeah.
Yeah, but again, it's just like
Well, it previously never even was an asset, though.
exact. Yeah,
So
but
is it
also
an
there was no
asset?
liability
Yeah.
previously, so it is. So I think that's the logic and Intisar behind it. Is just it's not liquid. You can't liquidate it, and this is why it's not sitting in current. But
Another
again, this is
question is that, like, I have a client who put all of the liability in a long term. That is wrong, right? They should
right.
have at least in the uh current term liability right of use. Uh, the amount that is in the current, is it with the interest or without just a principal?
So the amount in the current is to put it simple. I mean, the payment exact isn't exactly principal. It's just it's a combination of the present value of money and how much we're going to pay. It's not exactly equal to the payment. It's just it's a factor of not. When I show you, I'll show you the entries in a bit, and it's just a combination of both. But it's not necessarily principal because you're not paying a loan.
Okay.
All right.
All right.
All right, so we're getting to Leasecrunch. So once you get to Leasecrunch, I'm in the demo right now. This is how it's gonna look like once you go inside the client. So actually, let me go, for example. Okay, so normally when you get it's gonna look like this. You can have a list of the clients right here. So I'm using the test. And if you have leases already in there, you're gonna enter the leases for the client. And this is just gonna be the leases, for example, that I've entered before. However, we're gonna enter a new one right now, real quick. But one thing I wanted before we go there, if you go to the administration right here, yeah, and if you go to GL accounts, so you just select reporting entity. Once you have it, you can add it. If not, you're gonna have accounts right here. So the idea is that you can actually add the exact accounts that the client uses or we want to use for the client. So when you're getting to the journal entries, you can just select these accounts and the entry would pop up exactly with the journal with the account numbers and names. So you don't have to try to figure out like, okay, which account is this or which account is that. Once you enter it in here, you select it when you're preparing the lease, the entries update automatically and you don't have to do any additional effort. And again, you get there by going through administration, then to the GL accounts. So let me start here and we're going to add a new lease. Go right on the top and add a lease. Before I do that, just let you know we had a training that was done by Leasecrunch. So that video should be available for everybody. If not, just let us know. We should be able to share it. I'm just gonna go quickly, like go over the stuff that they provided, just for as a refresher. But we do have like a lot more detail if you guys needed that. So, anyways, this is the first screen that you're gonna get into when you're entering a new lease. Then if you have already a reporting entity, you can select a reporting entity. But in this case, I'm gonna add one and I'm gonna call it demo. I'm not sure. It's got 5. All right. So the initial application date always going to be January 1. So it doesn't select one. It's always gonna be January 2022. Okay. So can you guys hear me?
Yes.
Yep, just
Oh.
following along.
Oh,
We can hear
I
you.
just froze for like a second. Okay. Yeah. Demo 5 again, January 2022. Local currency, unless otherwise, it's going to be dollar. Add. Okay. So when you're filling this, by the way, anything that has a star beside it, you have to complete it. So lease, we're just going to call it office lease. Usually, if you have an address, you can put the address. So for example, let's say on 861 Wheelie Avenue. And if you know what that is, then you've been with Minimal Smart for too long. All right. Manufacturer, again, you don't have to enter this. And if it's office space, it's not really going to be even relevant. Then we're going to the asset type. And these are the options. You can add, by the way, if you want. Oh. So for example, that's going to be office space. Size, you don't have to enter this, but you can if you want to. Then location. Select location. Again, if you add the location, you can select the location. Most of the time, you're going to be putting the name of the address anyways. But again, if it's like, let's say, for example, if it's, let's say a computer, you want to put the location, you can. All right. Then going down here, select lessor. Again, you can add the name of the lessor if you want to. This is something that you're going to have to complete. So this is going to determine if the assets is going to be a capital lease or an operating lease. So as we already mentioned, sorry. I had my mouse just die on me right now. All right. So the date should be the term of the lease. And again, for all leases that we're starting as of 1/1/2022, regardless of when the lease is starting, for the modified retrospective. So it's always going to be 21/1/2022. Okay. And let's say, for example, in this case, in this exact situation, I'm going to use a 5-year lease, the exact one that I mentioned before, that's starting on January 1, 2020. So it's going through December 31st, 2020. Sorry, December 31st, 2025. So it is going to be 5 years, but we're only going through actually 2024, not 2025. But we're only going through 36 months of it. So even though it's 60 months, we only care about the period that's after the implementation date. So I'm going to go to the next. And early termination. If there is an early termination option, I almost never see these on the leases, but double check to ensure that there isn't one. So the answer is, I would say mostly going to be yes. Just double check the lease that you're looking at to ensure that's the case. And then renewal. So that one of the new things that's changing with a new standard, before when we used to have renewals, we didn't really care. The lease is 5 years and we don't expect it to renew. We're done. We're just going to work with the last year. If this was the old standard, when I do the commitment, it's going to be a commitment for 3 years and have a nice day. With the new standard, this is changing. If you have a renewal option that the clients thinks they're reasonably certain they're going to renew, which you're going to ask the client for, then you're going to have to put the new renewal option. If it's a no, then we're going to stick with what we have, which is going to be the case for this one as an example. Just heads up, if let's say, for example, they have an extension of 5 years afterwards, and the client is reasonably certain they're going to extend it for 5 years, our lease is not going to end at 2024. It's going to end at 2029. All right. Finish. I'm going to go to the next. Discount rate, again, I think it's 2.05. I'm gonna use that for now. This just let you know, you can look for 20-year. The risk-free rate is the 20-year treasury rate, which is right now at 4.47, very high, and 2.05. I would say that for any client that that has a modified retrospective, we're putting a lease that already existed, it's gonna be 2.05. All right. And payment, again, it's gonna be monthly for most clients, unless it's otherwise. Then you're gonna put that payment amount. This is gonna be exactly what the payment schedule is. So if the client, for example, has sometimes it be written specifically in the lease agreement. If it's not, then it says there is like a 3% escalation. You wanna calculate it first and figure out what that is, and just put it right here. And again, when you put the information right here, so for example, I'm using something simple, which coincides exactly as of the January 1st, and the client has their year is also on calendar basis. Just remember, if it's not, then you're gonna have to put the exact information as it is. So for example, this is the payment of, I'm gonna say the payment, for example, starts at $10,000 in the first year. We have 12 payments, and the first payment is January 1, 2022. Then that may not always be the case. It may not be 12 payments. So let's say, for example, the lease starts on July 1st instead of at January 1st. Then this probably is going to be 6. Then you're going to add the next one, which is going to be 12. So just keep that in mind. All right. Then I'm going to go to the next one. I'm going to go with $500 increases, but that may not necessarily be always the case. Too many zeros. Okay, again, 12 payments, 23. And then the last year is going to be 24. All right. The next thing that you have to take into consideration, if the client has any prepaids or deferred revenue coming from December 31st, 2021. So for example, I'm gonna go in here and say that the client had a prepaid rent of $1,000. They prepaid 1 month, which is gonna be January. Then I'm going to add, for example, let's say they have a deferred accrued rent liability. So they have, let's say, deferred rent. Oh, I used the, well, this was supposed to be the assets. And let's say the deferred rent is $50,000. Then usually you get deferred. I'm pretty sure, if you guys are not familiar, deferred rent before on the old lease standard used to happen if the client gets first based on the difference, because we amortize everything based on straight line. If the client get any abatement, for example, they're not paying for a month or 2, 3, whatever the case may be, that's always going to create a deferred rent. As well, the escalation of the lease is always going to result in a deferred rent as well. Because if you're, let's say, for example, paying over 5 years and it increases by 3% every year, when you divide it over a straight line, it's going to be in the first few years what you're actually paying in cash is less than your actual expense. Anyways, that's all gone. So when we get to the selecting the classification, this is something that you're going to have to complete for all leases. It used to be 4 criteria before, now they increased it to 5. And just to let you know, the only thing that changed is this one right here, which is, will the lease asset have no alternative use to the lessor at the end of the lease? Answer is usually going to be yes. If it's a no, then you're going to get into more detail. But anyways, if this is this is the idea here is this determines if it's an operating or a capital lease. So is there going to be a transfer of ownership? No. Is the lessee reasonably certain to exercise a purchase option? No. Asset have no. Would the lease asset have no alternative? No. Actually, not the yes. And then is the lease term 75% of the economic life? And if we go here to calculate, so what this is asking is that if the total value of the lease payments, or the right of use asset actually, is going to be greater than 75% of the economic life of the asset. This is not going to be too relevant when you're doing with office space, because office space is usually 30 years. And if you're paying for like 5 or even 10 years, it's going to be nothing. So for example, I'm going to assume right here the building is worth 2 million. Oh, the entire, sorry, this is the entire, this is the life. So I'm going to put it over 30 years. We're only getting it for 36 months, so that's just 10%. And again, when it gets to the fair market value, if you're in doubt, if you're dealing with office space, it's safe to say that you're not going to be happy at the 90% of the value by any means. So I'm going to use hypothetically here $2 million. Okay. But just keep in mind, if this is a printer, a vehicle, you probably want to figure out what this number is, or at least be close by, because it could be at 90%. Especially if you have like something that's on a 5-year, if you have a 5-year lease on a printer or a 5-year lease on a vehicle, it's probably going to be capital lease versus operating. All right. Next. And again, this is the stuff we already covered. If there's anything separate you can add, but this is just like the accounts. And if there's any variable lease payment, which there is. One thing as well you can do. There's no variable payments. Let's go to next. There could be, but there isn't. You can always attach the leases over here. If you have the lease agreement, I would actually advise that we upload the lease agreements with the lease. You can upload it right here. You can just choose the file. You might be able to even drop it, but this maybe. And we're done. Oh. So it's gonna show up here, which is this one right here. Now, since this is the demo, I cannot pull reports, but I'm gonna show you one client that we actually worked on before, which is Sensio, where we put 2 leases that the client had. So once you get here, you can, for example, pull a report. You can specify the dates that you want. Generally speaking, if you're working on calendar year, let's say 2022, it's going to be January through December. And then you can ask the system, for example, to pull all the journal entries, which is what I did and shared with you guys over here. And it's going to look like this. And again, this gives us the entry that we need to post. So if you enter the account name, we didn't enter accounts right here, but if you entered the accounts, entered all the information correctly, the idea is that you should be able to just go ahead and post the adjustments once they go out. And again, and for example, right here, I know you had one, for example, let's go to Marsh. I just want to pull, this is going to be, there's always going to be entry in the beginning, especially if you have deferred rent. Like this client here had a deferred rent, so you're implementing the asset, you're taking out the deferred rent and the prepaid and all that stuff in the first entry. Then there's going to be a monthly amortization. So for example, I'm going to go start here, for example, go for the February adjustment. This is the adjustment we're going to be posting monthly. We're going to record the rent liability, rent expense. We're going to be here over here, amortizing our liability and our asset. And at the same time, we are going to be posting the expense and whatever adjustments they need to make to balance the balance sheet. Now, this client had this specific lease had a little bit of out of the ordinary situation because it was a client, the lease that was expiring at the end of the year and they had a large deferred revenue. So this is why you're seeing like a huge number like this. It shouldn't be the case. Like, let's say if I go to December, that's still a large chunk. I was just gonna say the amounts should be much closer to each other. Like you wouldn't have something as big like this. And again, it depends on how much deferred rent in the initial when you initially put the lease in. If you had a lot of deferred rent coming from previous years, you might have like large amounts getting amortized on annual basis. I'm sorry, on monthly basis. If that's not the case, it's going to be adjustments in smaller values. And the amortization schedule is going to look like this. And this shows us like what account's getting hit and all that. I don't think you're going to need this document here this much. It's just there. It might help the auditors if needed, but I don't think even in our case we're going to need this schedule. This is we're going to always need the adjustments right here. Well, sorry, I take it back. So for the audits, we're going to need this schedule because that's going to give us the balances as of December or whatever the year end may be. If you're doing accounting, you wouldn't really need this. You would pull it out to check against it, just to make sure that your balances are up to date with what the amortization schedules are. This is going to be the schedule that you need to post the adjustment. And again, going back to Leasecrunch, the journal entries are here. The amortization schedule is here. The last thing, which I don't think anybody is going to need unless you're preparing the financial statement with notes, which as audit we are, but okay. I mean, I don't know if you guys in accounting do any financial statements with notes preparation. I'll take the silence as a no. But it's going to give us, for example, like the disclosures that we need over here. This is just the schedules, not the entire disclosure. So this is just the schedules that we need to disclose to the financial statement. Any questions on Leasecrunch? Anybody doesn't have access to Leasecrunch? Assume everybody's ready to run a lease tomorrow, right?
I think Nobu is definitely.
I can give it a shot. I'm always a team player, so I'll get right on in there and take care of it.
Welcome aboard. Yes, this is your
Yeah.
first task.
Hey, Ahmed, this is Leonard Trester. Question: how much, or how does the change in the lease accounting affect the tax return?
It shouldn't, as far as I'm aware. Well, the balance sheet itself. So as far as I'm aware, the rent expense itself is not really changing with the new standard. So what you recorded as part of your income statement, generally speaking, shouldn't change. Might be slightly different, but as a general speaking, it's not.
Now, you mentioned if you had prepaid or deferred rent, how that's going to flow on the tax return now under the new requirements.
Right. So going to the balance sheet, there's two things. Number one is the M1 reconciliation. Obviously, when you put the balance sheet, you're just going to put the book balance sheet, whatever the case it is, based on the new standard. However, when you're doing tax planning and things of that nature, you have to keep in mind that there isn't going to be a prepaid expense anymore. So you might have to ask the client or accounting how many months the client paid in advance, because it's not going to be straightforward to tell.
Okay.
Like there isn't gonna be a line that says here's prepaid rent and you can look at it. It's like, okay, this is 2 months. It's not gonna be the case anymore.
And the deferred rent that we're used to set up a liability for the asset or for the rent that you basically didn't pay on a current basis.
That's also gone. So it's gonna be embedded as part of the lease liability.
Mm-hmm.
So the idea is that the right of use asset and the liability are going to encompass everything that goes on the balance sheet and the income statement.
Yeah, but when that deferred rent or deferred lease liability disappears, is that a change in accounting?
No. So it's gonna be, if you remember when I mentioned earlier, we're doing what's called the modified retrospective. So yes, we're changing how it's going to be recorded in the first year. And again, I'm actually gonna go back to the Sensio example. Going to the journal entry right here. So this is this is the actual adjustment that we are posting in the Censure books as of January 1, 2022, which I think we already did. And the idea, if you look over here, yes, there are a lot of assets and liabilities. None of this is hitting the income statement for the time being.
Mm-hmm.
And for the most part, it shouldn't. Like if you see, for example, right here in the adjustment on the monthly basis, this is what's going to be recorded to go towards the income statement. And I think the payment was around that range as well, maybe a little less or a little more. However, there is going to be, well, I should have gone with this one. You are amortizing the asset against the liability for the most part.
Mm-hmm.
Versus it being part of the rent. Now, when you have a lot, the issue that I don't know if you guys, that's going to be impacting how that will impact the taxes, is that we, for example, we might have a $500,000 sitting in liability, which is now going to disappear, like deferred rent.
Mm-hmm.
And that's going to be going, like, it's embedded between the asset and the liability. It's not going against the income statement, so we're not posting an adjustment, for example, writing off $500,000 of deferred rent. That's not the case.
It's being
However,
reclassified, is what you're telling me.
yeah, it's going to be reclassified. Think of it this way: it's just it's a balance sheet to balance sheet change for the most part. It would have a little bit of an impact on the monthly rent. It definitely does, as a rent expense. So the rent expense is not going to be equal to the rent payment, whatever the rent payment is.
Yeah.
But it never does, anyways. When we're doing, I never used to.
Okay, well, we'll deal with it when it comes up.
Yeah. However,
Yeah,
that
so Leonard, in this case, we were concerned because we knew that this lease was changing at the end of 2022, but ASC 842 needed to be implemented at the beginning of 2022. And the deferred rent here was related to the old lease, including an abatement provision that was basically being recognized over the life of the lease. And so we put this into Leasecrunch to see what impact this was going to have in Leasecrunch, like per the Leasecrunch journal entries on the balance sheet through recognition of ASC 842 and that monthly, those monthly entries, right? And then this one actually changed at the end of 2022. There's a new lease. So we looked at all that movement because we were concerned about, is this implementation going to create a big taxable income event? And so we did speak to Steve about it, and it looks like there will not be a big impact, neither for GAAP nor tax. If there were, Steve was explaining that's a potential M1 adjustment.
Yeah. So as Maddie mentioned, Leonard, there shouldn't be, generally speaking, any changes to the income statement for the most part. It's all gonna be balance sheet to balance sheet. And I know Sensio here, actually Sensio is somewhat, it's the only one that we ran so far, but it's somewhat of a bad example because they had a major lease modification at the end of the lease period, which not at the end of the lease period, at the end of 2021, 2022, which under GAAP, actually both the old and the new standard, if you had like a major modification, the old lease is considered null, and whatever is the date as of that date is going to be considered a new lease. So we actually divided that specific lease into two leases, one of it before November 1st. So we had to first implement the new accounting standard as of January 1st. Then as of November, we had to go in and close that lease, then open a new lease for the same exact lease because there's a major modification. We're not going to run into this in like 99.9% of our clients. So that's like a special case.
I guess my concern is whether the change in the treatment represents a 3115 requirement for accounting change. And that, I guess, that may be addressed somewhere in the literature.
I don't believe it does.
I
But
don't know.
that's a good point for us to look into. Thank you, Leonard.
You're welcome.
Any additional questions?
Hey, Ahmed, in that example, what was the actual payment for Sensio? Was it that 114,
It was high.
116,000?
Yeah,
It
it
is
was
that
it was about that much. Yeah. Okay. Yes, Leonard, I think you're right. You do need to do a 3115 now that I'm looking it up.
Okay, just. You know,
Yeah, and again, yeah, Patrick, I think the case for Sensius in particular, because the lease was because there was a major modification that's kind of screwed things up.
Okay, just curious.
Yeah, you wouldn't normally see that I would say in most leases, because the deferred rent is usually not that high in most situations.
Thank you both. It's been very instructive.
You're welcome. So, okay, going once, twice, and we can stop the recording.
Okay.